So the very last thing that we looked at in the last class was that the adjusted trial balance is exactly where we look to do our financial statements. Now, those are the final financial statements for the period of time that we're looking at. So in this case, for Sierra Corporation, it was just the month. But normally speaking, we would certainly do all the adjusting entries at a bare minimum once a year. But anytime a financial report, like an income statement, needs to be produced and prepared, we're doing the adjustments. However, we have an issue. So once the adjusting trial balance is done and we actually do our financial statements, the income statement, as you know, and the retained earnings statement, as you know, cover a period of time, because the income statement and the retained earnings statement are the statements that are ruled or by the periodicity assumption. Remember, in Learning Objective 1, there were a few things that this chapter brought to your attention. One is the periodicity assumption. We assume that a business breaks up its time periods for reporting purposes, which is what an income statement is for reporting, monthly, quarterly, and yearly. So the shortest period of time a company will report is a month. And as you see, this particular company, Sierra Corporation, you saw reported for the month ending October 31st. The longest period of time companies are allowed to sort of summarize, right, their revenue, expenses, and net income is 1 year, because the periodicity assumption is in play. The artificial time periods can only last no longer than 1 year. So what happens after 1 year? What happens after 1 year? Well, all these records for revenues and expenses have to start again. They have to start again. The same thing for dividends as well, by the way. We have to keep track of these accounts separately, year to year to year to year to year. So the longest we can actually do a report a financial period is 1 year. And we have to keep the records separate year to year. So at the very, very end of the accounting period, we have to go through a process that we call closing the books. And closing the book simply means that our revenue accounts, our expense accounts, and our dividend account need to be zeroed out at the end of the period, because the very next day starts a whole new year. So on a calendar year, for example, the very last day in a calendar year would be December 31st. So at the end of December 31st, that's the end of the accounting period, the company would do all of the adjusting entries that we did in this chapter and more. They would prepare an adjusted trial balance. Then they would prepare their final yearly income statement, their final yearly retained earnings statement, and of course the balance sheet for that day. The very next day, January 1st, represents a whole new year, a whole new accounting period. And because you have to keep those accounting periods separate, well, you have to keep your revenue, expense records separate year to year. Dividend records as well. So because we actually have to close these accounts, which simply means bringing a balance to zero, as you'll see very shortly, all the revenue accounts, all the expense accounts, and all the dividends accounts will, at the end of the accounting period, be zeroed out, will be closed. So the very next day, we can start new records. There'll be a new record of revenue for that new period, that new accounting period. There'll be a whole new record of expenses for that new accounting period. And we'll keep track of how many dividends were paid during that new accounting period. Think of it, think of it as you age, right? If you're having a hard time understanding how things close, think of your age. When you were 16 years old, you turned 16 on a particular day, and you were 16 for a whole year, right? The very next birthday marks when you turned 17, right? Well, then in this case, what you're trying to do is the accounting period is all those days that you were 16 years old. And you want to keep a record of all the money you earned, all the expenses you had, things like this. But the very next day that you turn 17, you have to sort of clear these out, because when you turn 17 and for the whole year that you're 17, you're going to be keeping track of these separately from when you were 16. And so this is sort of what companies have to do on either on a calendar year basis, keep the calendar year records separate from each other, or on a fiscal year basis, in which case they could have used your birthday. They could use any 12-month period they wanted. Either way, the process is the same. At the end of that accounting year, specifically the year, these records have to be cleared out. We call that closing the books. They're not technically zeroed out and then we forget about that money. Remember, everything has been transferred to retained earnings, right? Revenue and expenses will give you your net income. Net income goes on the retained earnings statement. We take away dividends, and that gives you the ending retained earnings. Retained earnings is a stockholders' equity account, which is a permanent account. These accounts don't go through that same period. They're not, the balance sheet is not subject to the periodicity assumption. We don't separate the balance sheet into different periods like we do the income statement, right? The income statement, we report for the month, we report for the quarter, we report for the year. Balance sheets, we report for the day. It doesn't apply to the balance sheet. It only applies to the income statement and the retained earnings statement. So that's why this process of closing the books only applies to what we consider the temporary accounts, revenue, expense, and dividends. They're temporary because at the end of every year, we close them. So the very next year, we can keep separate record. So the process of closing involves entries. Of course, everything in accounting starts in the journal. Accounting isn't happening without something being put in the journal. So these entries are called closing entries because they're journal entries that we make to close out our accounts. There are 4 steps that we use. The very first thing we do is we close our revenue accounts to 0. Now, when you close an account, you're simply getting the account balance to 0. So for example, if you have $1,000 in your savings account, how do you get it to 0? You take $1,000 out. That's how you get it to 0. Well, in accounting, the same thing happens. How do we get sales revenue or service revenue to 0? Well, in order to get any account to 0, both the debit side and the credit side need to equal. Thus, the balance is 0, right? So we would, in essence, to get revenue to get to 0, to close, we would need to actually debit the revenue account, because the revenue account already has a credit in it, because revenue is a normal credit balance. So to get this account to 0, we actually have to debit the revenue account to get it to 0. Well, what do we do with that money? We temporarily transfer it into this account called income summary. Okay. So the very first step is we close the revenue account with the debit and we move the credit over to income summary. Now the revenue account has a 0 balance because the credit side and the debit side are equal, right? If you have 10,000 of credits and 10,000 of debits, there's no balance in the account. That's closing. That's the close. The second thing that we do is close your expense accounts. Now, expense accounts have balances in them on the debit side, right? If you look at a rent expense account, the balance would be on the debit side. Well, how do we get that account to 0? Well, we're going to have to put a credit in each of the expense accounts to get each expense accounts to be zero. Well, what do we do with all those debits in those expense accounts? Well, we transfer them temporarily to the income summary account. So after the first two steps, we have a zero balance in our revenue account. And we have zero balances in every single expense account. Every single expense account needs to be zeroed out, which means every single expense account is going to get a credit for the amount that's on the debit side. When the debit side and the credit side equal, the balance is zero. So we have already here, just in these first two steps, we've closed all the revenue and expense accounts. Well, we're not done. We have this temporary holding tank that we call income summary. We don't need it anymore. The only reason we needed it in the first place is because we had to transfer these to revenue and expense balances so we can zero those out. So now what's sitting in the income summary account is all the revenue and all the expenses. Okay. Obviously, the revenue would be on the credit side. All the expenses would be on the debit side, right? Because we just transferred them here. So the third step is we don't need this income summary account anymore. We can actually dump the difference into retained earnings. Well, the difference in the income summary account is going to look exactly like your income statement. Again, because you have your revenue on one side, you have all your expenses on the other side. What's going to balance it out is the profit in the company. So we get income summary to a zero balance, usually on the debit side, and we move the credit over to retained earnings. Now, that makes perfect sense because increasing retained earnings happens on the credit side. And this is the same as adding the net income to retained earnings, which would happen on the credit side of the account. And the very, very last step is relatively easy. The fourth step is we have to close the dividends account. Well, dividends, as you know, has a balance sitting on the debit side of the account. And so how do we close the dividends account? In other words, how do we get the balance to zero? Well, we have to credit the dividends account by the same amount to get it to zero. And we move the debit directly into retained earnings. Now, the debit to retained earnings would shrink retained earnings, which is exactly what dividends do. Okay, so those are the closing entries that we would do. This is the step 1, 2, 3. That's a 4-step process. It's relatively easy after a while. This is what it would look like in the journal. Here's your very, very first step that I mentioned, right? To close your revenue account, revenue has a credit balance, so you have to debit the revenue account so both sides equal. That's how we close an account, both sides equal. And so we move that money over to income summary, that sort of temporary holding tank that we have for this. That's the first step. The second step is we close all the expense accounts. Notice the expense accounts now have equal numbers of credits. And so all of the expenses are now moved to income summary. But look what's happening. Income summary looks like the income statement, right? Remember that income statement that we just looked at from Learning Objective 4A. You had $10,600 of revenue for this company, Sierra Corporation, 7,740 of expenses. So right in the income summary account, you have revenue on one side, expenses on the other. These are the totals. The third step is now we can dump the difference into retained earnings. So we don't need income summary anymore. So in order to, again, this is the only time we use income summary. So there's only two things in income summary. On the credit side of the account, 10,600. On the debit side of the income summary, 7,740. In order to zero it out, both sides have to equal. So you have to increase this to match that, which is why we debit it by 2860. If you notice, 2860 is the exact amount of the net income for Sierra Corporation just a few pages before, right? So the net income basically is debited from income summary and moved to retained earnings on the credit side where it belongs. And the very last step here is closing dividends. Dividends has a debit balance, so the equaling credit balance will bring that account to zero. We move the debit over to retained earnings. Look what's sitting in retained earnings, right? Retained earnings. We have a $2,860 credit, which increases retained earnings. That's the same as adding net income on the retained earnings statement. And then a debit to retained earnings for $500 is the same as subtracting dividends from the retained earnings statement. Right? So if you remember that retained earnings balance, it's $2,360, which is the difference between these two. So this is how that looks. There's a graphic of this on page 176, I believe, no, 177. So this is on page 177 in your book. And it just basically shows the step. The very first step is we close service revenue with a debit and move that money over to income summary. This is your temporary account. So look what happens here. Now that the debit side and the credit side are equal, the balance is zero. That's closing. That's closing the account. Okay, it's not that bad. The second step here are closing all of your expenses. Expenses have debit side balances, so all the closing entries are going to be on the credit side to get each and every expense to balance to zero. Once they're closed, the total expenses go here, $77.40. The income summary account is going to look like the income statement in the sense that the three numbers you see here are exactly the same three numbers you'll see for totals on the income statement. Total revenue is here. Total expenses are there. The difference is your profit. Well, we don't need the income summary account anymore, so we're going to move that profit directly where it belongs, which is retained earnings. Retained earnings is a stockholders' equity account, increases on the credit side. So profits increase stockholders' equity, retained earnings specifically. So that's perfect. The next thing is to close dividends. Dividends has a $500 debit sitting there. We credit it for $500. That brings the balance to zero. That's what closing is, right? And move that to the debit side of retained earnings. Well, look at retained earnings. This is the retained earnings statement. Beginning balance, adding the net income, taking away the dividends, new balance and retained earnings. Once you do that, all of the revenue expense accounts and the dividends account will be closed. So they actually do one more trial balance, which I'm not going to force you to do, which is called the post-closing trial balance. And all that will be left on that trial balance are the asset, liability, and stockholders' equity accounts. Dividends will be zero, revenue will be zero, all your expenses will be zero. Why? Because you just zeroed them out. Okay, so again, all temporary accounts will have zero balances here because you already did all the work. This whole chapter 3 and 4 is listed right here. Everything we did was the accounting cycle. Chapter 3 handled all the first 4 things here. And then look what we did in chapter 4. Amazing. Closing the cycle. And so this is, and of course your book goes through this. I'm not going to go through it because I've already gone through it with you the last few weeks. But I will do the closing entries, do an exercise with you, which is on page 179. So if you actually have your book with you and you go to page 179, you will see this. So we basically are going to do closing entries, which is that 4-step process that I outlined earlier, right? We close the revenue account, move that to income summary. We close the expense accounts at step 2, move all of that to income summary. Now we no longer need income summary, so we dump all of that into retained earnings. And the last step is to close dividends. So that's important to know because the only accounts that close are temporary accounts, revenue, expense, and dividend accounts. If it's on the balance sheet, it's a permanent account and it doesn't close. So if you notice here, the very first statement, the very first account that's listed is accounts payable. That's a liability. That's not included in the closing entries because a liability account is not a revenue account, it's not an expense account, and it's certainly not the dividends account. So we don't even have to pay attention to this first number. Okay. The revenue account, we need revenue. That's part of our first step. The expense accounts, yes, that is step 2. This is an expense account, that's step 2. The dividends account is going to be the very last step. Okay. We will look at retained earnings because that's going to be obviously part of step 3 and 4. Accounts receivable is an asset account. Assets are not involved in this. We don't need this. But we certainly have another expense, and that's certainly part of step 2. So the very, very first step we have is to close the revenue account. And we do that by moving that money to retained earnings. Sorry, moving that money to income summary. So a debit to service revenue would bring the balance in the account to 0 because this 98,000 is on the credit side. When you have an equal number, 98,000 on the debit side and 98,000 on the credit side, the balance is 0. We move that to income summary. So the first step is done. The second step is to close all the expense accounts, and we have 3 expense accounts to close. Each individual account needs to be zeroed out. The total amount of the expenses are going to be put into income summary on the debit side. So in this case, we have 3 expense accounts that need to be credited to close to 0. Each account is now 0. The total amount of expenses will be put into income summary. So what's left, what's in income summary right now is all the revenue is here, 98,000. All the expenses are here, 80,000. So if you knew that a company had 98,000 of revenue and 80,000 of expenses, you knew this company had a profit of 18,000. That's going to be the net income. So now that's the second step. The third step is now we no longer need income summary. We no longer need that account. So we can close the income summary account into retained earnings. That $18,000 I was telling you about is the profit. And that profit or net income is going to be added to the retained earnings account on the credit side. Income summary gets debited, so it's basically zeroed out, and we no longer need it. And the very fourth step is closing that dividends account to retained earnings. So dividends we close on the credit side because this is sitting on the debit side. So that credit will equal 0. Both sides will be equal. And we move the dividends to retained earnings. Okay. So that's closing entries. That's closing entries. I mean, I repeated things quite a bit because I can't help but think that that's the most important part of why we do this. Understanding that the income statement and the retained earnings statement fall under the periodicity assumption that they measure time periods, but they can't measure anything longer than a year. Then that record has to close and a new record begin. So that's really the important part of why we do this. We need to close out the records for one accounting year and have a clean start for the next accounting year in those accounts, revenue and expenses, and the dividends account. Okay. And so that's the whole purpose of all of this. Questions?